All right. So today we are going to be discussing, we are going to have an illustration on project specific. In our last class, we discussed project specific, all the relevant concepts in relation to project specific cost of capital. We talked about the introduction to cost of capital by saying that cost of capital project specific work is computed when a company is diversifying into a new industry or when systematic business and financial risk are expected to change as a result of undertaking a project, because the existing work of a firm will not be suitable to evaluate projects in a new industry. Every industry, every business, every industry has its own peculiar risk. Therefore, once a company is undertaking a project in a new industry, then there will be need to estimate a cost of capital that will be appropriate and consistent with the project risk. This is what is known as project-specific cost of capital. We talked about some terminologies, which I'm not going to repeat. Of course, we talk about what is business risk, what is financial risk, then how do you measure business and financial risk. So we said to measure business and financial risk, you need a beta value. And we said beta value is divided into two. We have asset beta and also equity beta. We also talk about a proxy company. We said proxy company is a comparable company that operates in the industry where a company is moving into. All right. The assumption usually is the fact that both the main company and then the comparable company have similar business risk, and that's why you are borrowing the beta of a proxy company. Of course, I gave you 5 procedures to calculate project-specific work. The first step is to identify the proxy beta. Then step 2, you ungear the beta if it is geared. Step 3, you re-gear the beta. Then step 4, you calculate cost of equity using capital asset pricing model. And then finally, you calculate project-specific work. Okay? So these are the procedures you are expected to carry out anytime you want to compute project-specific cost of capital. So right about now, what we are going to be doing is to do calculation. All right. So like I mentioned, when we get to capital budgeting as well as a business valuation, we are still going to estimate at least 2 additional project-specific cost of capital. All right. So, but for now, let's demonstrate for the purpose of those that are just learning project-specific for the first time. Let's learn about how to estimate project-specific work. So now that we know when you are expected to calculate project-specific work, so let's have illustration to demonstrate that. Let's have illustration to demonstrate that. So my target is to complete this within the next 1 hour. Then we'll spend the remaining 1 hour to discuss Wakuka. Okay. So I need one of you to read for us. Who is going to help us? Who is going to help us to read?
Hi, good evening, sir.
Okay, go ahead, Sylvia.
Kilimanjaro PLC produces domestic electric heaters. The company is considering diversifying into the production of freezers. Data on 4 listed companies in the freezer industry and for Kilimanjaro are shown below. We have Mississippi.
Hello, Alaide.
Yes, sir.
You can raise your volume a little bit.
Okay, sir. So we have Mississippi, Limpopo, Zambezi, and Kilimanjaro. The par value per
Still the same
ordinary
thing.
share.
Maybe you are far away from your speaker.
Okay. Can you hear me now? Is it better now?
Better. Right.
Okay. The par value per ordinary share is 25K for Mississippi and Zambezi, 50K for Nile and 1 naira for Limpopo and Kilimanjaro. Corporate debt may be assumed to be almost risk-free and is available to Kilimanjaro at 0.5% above the Treasury bill rate, which is currently 9% per year. Corporate taxes are payable at a rate of 35%. The market return is estimated to be 16% per year. Kilimanjaro does not expect its gearing to change significantly if the company diversifies into the production of freezer. You are required to estimate what discount rate Kilimanjaro should use in the appraisal of its proposed diversification into freezer production. 2. Corporate debt is often assumed to be risk-free. Explain whether this is a realistic assumption and calculate how important this assumption is likely to be to Kilimanjaro's estimate of a discount rate in A above. For this purpose, assume that Kilimanjaro and the 4 freezer companies all have a debt beta of 0.3. 3. Discuss whether systematic risk is the only risk that Kilimanjaro's shareholders should be concerned with.
Thank you, Alaide. Yes, that is the question. In the first requirement, examiner is asking you to estimate what discount rate Kilimanjaro should use in the appraisal of its proposed diversification into freezer production. So examiner is asking you to estimate discount rates. So you then need to ask yourself, what kind of cost of capital are you expected to calculate? Is it traditional work? Is it project-specific work? Is it Wakuka? So as you can see from this question, we are not given information about capital structure, right? In that case, there is no need for us to calculate traditional work. Therefore, we are going to estimate project-specific. Why is it project-specific? Because examiner has told you, when you look at these requirements, you are asked to estimate the discount rate that the company is going to use for the appraisal of its proposed diversification into freezer production. So that is a clue to know that you are expected to calculate project-specific cost of capital. Not only that, when you look at the introduction of the question, you are told that Kilimanjaro PLC produces domestic electric heaters. That is the object clause of this company. The company only produces electric heaters. However, examiner now mentioned that the company is considering diversifying, okay, into production of freezers. The company currently produces heaters. They now want to diversify into production of freezers. So because this company is diversifying, therefore, we need to calculate project-specific work. Now, the name of the main company is Kilimanjaro PLC, right? Then you are given other companies different from Kilimanjaro. You are given Mississippi, Limpopo, Zambezi, and Nile. There are 4 other comparable companies operating in the freezer industry. These are proxy companies. Therefore, we are going to borrow the beta. The first step of calculating project-specific work is to identify the beta. You ungear the beta if it is geared, you re-gear, you calculate CAPIMs, then you calculate work. That's all you need to do. Therefore, let's begin step by step. So the first step is to identify the proxy beta. When you look at the table given to you, the last line item you have there is beta equity. So beta equity of Mississippi is 1.10. Beta equity of Limpopo is 1.25. Beta equity of Zambezi is 1.3. And then beta equity of Nile is 1.05. There are 4 different betas because you have four different companies. Then what are you? So you need only 1 beta. Therefore, you need to add up all the beta, then you divide it by 4. That will give you the average beta. So without wasting more time on this, I will just come here, solution. The name of the main company is Kilimanjaro PLC. So we want to calculate project-specific work. And we said the first step is to identify the proxy beta. So there's no need for you to say on the day of your exam, no need to say identify the proxy beta. You can just say at a maximum, you can just say proxy beta. All right. So what is the proxy beta in the question? This will be equal to, let me bring it out. I need the symbol for beta. Okay. Get out. Beta, where are you? Yes, here you are. So beta is denoted as you have it here. So you need to ask yourself, I need the beta proxy company in the question, and you have to find the average beta. Therefore, I need beta of Mississippi plus beta of Limpopo plus beta of Zambezi plus beta of Nile. All right. So you then add everything together. On the day of your exam, no need to be writing MLS, ZN, whatever. Just go ahead, use your calculator, add up the beta together, the 4 of them. Then you just divide it by 4 because there are 4 different proxy companies. So you divide it by 4, and that's what you need to do. You move on from there. Don't need to be wasting time because you don't have the time to waste. All right. So according to the question, the beta of Mississippi is 1.1. So I have 1.10.
Limpopo 1.25.
1.25. Zambezi
1.30.
1.30. Then Nile
1.05.
1.05. So you had everything together, you then divide it by 4. There are 4 different, let me just copy from previous calculation. Which one is, okay, let me just use this one. Get out. Okay.
The total.
I'm coming. I want to redo it. There is 1.10. Let me just copy this. Let me just copy this and paste. All right. Divided by 4. There are 4 freezer company, and the total is what?
1.175.
1.175. So 1.175. That's the average beta. All right. So you can, because according to the question, the beta given to us is in 2 decimal points. So we can restrict this one to 2 decimal points. So we can then say our average beta is equal to 1.18. All right, here is 1.18. So with this, we have identified the proxy beta. All right. This is step number 1. Step number 2 says you should ungear the beta if it is geared. The beta will be geared if the proxy company has debt in its capital structure. All right, that is what I told you last time. The beta of 1.18 will be geared if all the four freezer companies have debt in their capital structure. So in this case, we need to go back to the balance sheets or to the financial statistics given to us and check if there is debt. Now you can see under the finance by, we are given bank loan for all the four freezer companies. So bank loan is a form of debt. Therefore, because they have bank loan, it means that the 1.18 is a gear beta. If 1.18 is a gear beta, then we need to ungear. All right. So how do you then ungear? To ungear, I said there are two different formulas that you can use depending on whether or not debt beta is given, right? So in this question, we need to check if we are given debt beta so that we will know the appropriate formula to apply. All right, let's check if we are given debt beta. So according to the question, we are not given debt beta. So it means that debt beta is assumed to be risk-free. However, when you look at requirement number 2, you are given a debt beta of 0.3. That is not what we are looking for because this one is meant for requirement number 2. All right. So in the main calculation, we are not given debt beta. It means that debt beta is assumed to be risk-free. So if that is the case, let me go and pick my formula here. So because debt beta is assumed to be risk-free, we can use any of these two formulas. Whichever one we use, we are going to get the same answer. Okay. So let me just let me use a proper. Okay, let me just manage this one. All right. Let me put it there for you. Since debt beta is not given, it is assumed to be risk-free. Therefore, the formula below will be used to ungear. All right. So to ungear is simply beta assets equal to beta equity of a gear multiplied by equity value over equity plus debt value multiplied by 1 minus tax. That is the formula to ungear. Okay. Step 2. Okay, so another thing I need to add to this information here is that, let me rewrite this. Since the four freezer, let me put it this way. The four freezer company have debts in their capital structure. Therefore, the beta in step 1 is geared. Because it is geared, we need to ungear it. Also, since debt beta is not given, it is assumed to be risk-free. Hence, the formula below will be used to ungear. Hence, the formula below will be used to ungear as debts in their capital structure. Okay, then. So I will then come here. Beta assets or asset beta is computed as beta equity of a gear. The beta we identified in step 1 is 1.18, which is a gear beta. I need equity value of the 4 freezer companies. I also need the debt value of the 4 freezer companies. I need the tax rates of the 4 freezer companies. So in the question, let's go and identify the equity value. If we don't have equity value, we need to find a way of calculating it. The same way you normally calculate equity value under the traditional work. Okay, that's the same way you are going to do it here as well. So how do I calculate equity value? We said equity value is number of ordinary shares multiplied by share price. Okay, if that is the case, according to the question, we are given ordinary share capital of 4,000, 9,000, 35, and then 53 for Mississippi, Limpopo, Zambezi, and Nile, respectively. All right, these are share capital. We need ordinary shares, number of ordinary shares. So to now get the number of ordinary shares, you are supposed to divide the share capital with a par value. We are given par value of 25 kobo for Mississippi and Zambezi, then 50 kobo for Nile, and then 1 naira for Limpopo and Kilimanjaro. So without wasting more time on this, let's go and do workings. So working number 1, what do you want to do? We want to calculate market value. So calculating market value, okay, of equity denoted as E. Get out. And debts, market value of equity and debt denoted as D. All right. So if that is the case, how do you do this? I will then come down here. We said that equity value is computed as, because in this question, we don't have, right? We don't have number of ordinary shares. Therefore, our equity value will be computed as share capital. Okay, this will be computed as share capital divided by, in the question, the examiner has given us par value. So that's what you are going to use instead of nominal value or nominal price. So since we are given par value, that's what examiner call it. So you use whatever examiner has called it. All right then. Okay, then multiply by share price. Pay attention to this. Examiner has hidden something in this question. The share price is not given to us. How do you then calculate share price? All right. How do you calculate share price? It's not given to you. So remember, for those of you that did skills level, for those of you that did not jump fence through McCarthy, yes, you are aware of the fact that if you want to calculate share price, okay, when we want to calculate price earning ratio, for example, we say price earning ratio is computed as share price divided by earnings per share. Let me put it down for you somewhere. Okay, let me put it down somewhere. Remember, we say price earning ratio is calculated as share price divided by, let me use this. Okay. Share price. Divided by earnings per share. This is the formula for calculating price earning ratio. So in this particular question, pay attention, please. In this particular question, examiner did not give to you share price. So, but you are given earnings, you are given earnings per share, you are also given price earning ratio. Therefore, share price will then be equal to price earning ratio multiplied by earnings per share. From this, my formula here, what am I supposed to do? I will just cross multiply. To get this, I want to make this numerator the subject of the formula. In that case, what I need to do is to just cross multiply. Therefore, share price will then be equal to share price will be equal to price earning ratio multiplied by earnings per share. That's it. So that's what the examiner is hidden in this question. So I will just come here, right? Let me just put it down for you as a note so that you know how we get our numbers. All right. So that is that. Next item. So if that is the case, let me just put it here. That is PER multiplied by earnings per share. So that's how we are going to get our numbers. We then begin to solve it one by one. The first proxy company is Mississippi. Mississippi is denoted as M. Okay. Then what is share capital of Mississippi? Give it to me. 4,000 naira divided by what is the par value? What is par value of Mississippi? 25 kobo. Okay. So here will be 4,000. Let me continue to use this. So the share capital of Mississippi is 4,000 naira. The par value is 25 kobo, 0.25. Then multiply by, I don't know, we need to go and work it out. I will then come here. Price earning ratio of Mississippi is 12 times. Then earnings per share is 25 kobo. So this will be 12 multiplied by 0.25. Give it to me. What do you have? 12 multiplied by 0.25. What do you have there? That should be Z3 naira. Yeah.
Yes, sir.
All right then.
Sir, can you please write the par value in full under the formula there?
I should write what?
The par value in full. Is value missing?
Oh, okay. Par value. All right, thank you. So what do you have here as the total?
48,000.
12,000 multiplied by 3.
48,000.
That's what?
48,000.
48,000. That is 16,000. Yeah, 48,000. 16,000 multiplied by 3. So this is the market value of equity of Mississippi. Next one is Limpopo, denoted as L. You repeat the same thing. Definitely mute yourself. Your background is So again, I will go to the financial statistics. share capital of Limpopo is 9,000. The par value of Limpopo is 1 naira. So here will be 9,000 divided by 1 naira. Then I need the share price of Limpopo. I'm not given share price. Therefore, price earning ratio of Limpopo is 10 times multiplied by earnings per share of Limpopo, 0.533. Okay, so 10 multiplied by 0.533. Here will be 10 multiplied by 0.533. So what do you have there?
5.33.
5.33. Multiply by 9,000.
47,970.
47,970. All right. The next one will then be the next one will be Zambezi, denoted as Z. The share capital of Zambezi, according to the question, is 3,500. The par value of Zambezi is 25 kobo. 3,500 divided by 25 kobo. Then the earnings per share and the price earning ratio of Zambezi. P ratio is 9 times. 9 multiplied by 0.381. Okay. Here is 9 multiplied by 0.381. What do you have there? 9 multiplied by 0.381.
3.429.
3.429. All right. So 3.429 multiplied by 14,000.
48,006.
48,006. Okay. Next one. The last one is 9. Let me see. It will still come down. So the next one is 9, denoted as N. Okay. The share capital of 9 is 5,300. And also, the par value of 9 is 50 kobo. 5,300 divided by 0.5, that's 10.6. 5,003 divided by 0.5. Then, price earning ratio of 9 is 14, multiplied by earnings per share of 0.323.
4.522.
Okay. Here is it 9? Let me check again. 14. Here is 14 multiplied by 0.323. 323, is it? Let me check. Yes. So what do you have? You say it's 4 point what?
4.522.
4.522. 4.522 multiplied by 10,600.
47,933.
47,933.2.
9 what?
33.
33.2.
33, okay. Now, we have calculated market value of equity for all the proxy companies. So we then need to get the total value of equity. Total market value of equity would then be equal to, you had the four of them together. What do you have? For Mississippi plus Limpopo plus 9, plus Zambezi, and then plus 9 equal to, what do you have here?
191, 797.
191, let me just write this one. 191,
797.
797, okay. No, that's not correct. The last one here, this one is 6, this one is 3.
191 909.
909, okay, 909. All right, let me just write it out. The first one is 48,000 plus the second one is 47,970 plus the third one, which is 48,006. Okay. And the last one is 47,933. So that's what gave us the total of 191,909. So now that we have the market value of equity, I will then come here in my formula. E is equal to 191,909 divided by 191,909. I also need the debt value, right? So I will then go back to the question. What is the nature of the debt? Is it traded debt or non-traded debt? In the question, you are given bank loan. So that is non-traded. We don't have market value for non-traded debt. No, there's no market value for bank loan. Therefore, we are going to use the book value. So all we need to do is to just add up all the bank loan for the 4 freezer companies. So I will come here, debt value, right? Debt value denoted as D will be calculated as, let me put it this way. The freezer companies, the proxy companies have bank loans. If the proxy company have bank loans, there's no even need for this. Let me just shorten this. No need for this. That's a waste of time. Just a bank loan. Okay. Bank loan of Mississippi plus that of Limpopo plus bank loan of Zambezi, then plus bank loan of 9. Therefore, debt value would then be equal to, what is the bank loan of Mississippi? What do you have there?
5300.
5,300. Okay. 53. On the day of your exam, no need to be doing this kind of working. Just carry your calculator, punch it, then you get your total, you move on from there. You don't have time. 12,600. Don't go and be wasting time and be doing it one by one. All right? But we're in class and I need you to understand this. So that's what I'm taking my time to be doing it one by one. Okay. Okay, 18,200 and 4,000. 18,200 plus 4,000. So what's the total? Add it up.
40,100.
40,100. All right. So the book value of the debts is 40,100. So here our D is equal to 4,100. Then the next thing I need to do is to adjust for tax. I will then go back to the question. You need the tax rates of the proxy company. All right. But in the question examiner has told you in the last paragraph that corporate tax are payable at the rate of 35%. All right. So this 35%, examiner did not tell you whether it's meant for Kilimanjaro or the proxy company. So since examiner is silent about it, it means that both the main company and the proxy company have the same tax rates. So we are using 35%. At times, examiner will separate it. All right, whatever examiner has used is what you should, whatever they call it in the question is what you should use. So if tax rate is 35%, it means that we are supposed to account for 65%. So 0.65. Finally, give it to me. What's your final answer on this? We are going to start from the denominator. 0.65 multiplied by 4,100 equal plus 191,909 equal. Then 191,909 divided by answer equal multiplied by 1.18. What do you get? Give it to me. Yes. Am I on my own?
Who with you, sir?
1.04
1.04.
1.04. All right. So asset beta is 1.04. This is the beta that measures. This is the beta that measures the freezer industry. This is the beta that measures the freezer industry. So the next thing I need to do is to then regear. I will then say regear. Remember what I told you. When you are calculating for step 1 and step 2, you need information about the proxy company. Okay? Then from step 3 to step 5, you need information about the main company. This is what you are supposed to do. All right. Let me remove that. Okay. So, to regear, it depends on whether you are given debt beta or debt beta is assumed to be risk-free. In our own calculation, debt beta is assumed, since debt beta it is not given, then it is assumed to be risk-free. So to do this, we need to calculate beta equity of a gear company. How do you calculate beta equity of a gear company? So let me just copy this formula. Okay. So the beta equity of a gear company is computed as beta assets we have calculated in step 2, multiplied by 1 plus 1, multiplied by 1 plus 1 minus tax rate of the main company, or multiplied by debt equity proportion of the main company. Okay, this is step number 3. All right then. So how do you then calculate? I'll then go back to the question. Let me just copy this. I will go back to the question. What is my beta assets? We have calculated beta assets to be equal to 1.04. All right. Then multiply by 1 plus debt multiplied by 1 plus 1 minus tax. So we are given the same tax rates. This is 0.65. 1 minus 0.35 is 0.65. Then I need debt equity proportion of Kilimanjaro. Kilimanjaro is the main company. Therefore, I need the value of equity and debt of Kilimanjaro. So let's go and work it out. All right, so let me do it this way. This information is for proxy. We are starting with a proxy company. This one is for proxy. All right. Yeah, we do for the main company, which is Kilimanjaro. Kilimanjaro. So equity value of Kilimanjaro will be computed as the same way we have done before. Let me just copy one of them. So the share capital of Kilimanjaro, according to the question, is 4,000. Then the par value of Kilimanjaro is 1 naira. 4,000 divided by 1 naira. Then we need to calculate the share price of Kilimanjaro. How do we do this? The same way. The price earning ratio of Kilimanjaro is 8 times. Then earnings per share is 1.06. That is 106 divided by 100. So that will give us 1.06. So 8 multiplied by 1.06. What do you have?
8.48.
8
points.
So it's what? 8 point what?
8.48.
8.48.
Yes, sir.
So multiply with 4,000. What do you have there?
33,920.
33920. Okay. Then the debt value of Kilimanjaro, which is the bank loan of Kilimanjaro, is equal to
17.4.
bank loan of 17,400. 17,400. Here is 17,400. So debt equity proportion will be 17,400 divided by 33,920. Okay. So here is 17,4. D is 17,4. Equity value is equal to 33,920, right? Let me confirm. Is it 920?
Yes, sir.
So when you are doing your calculation, you are going to start with the division. Okay. This will be equal to 17,400. 17,400, then divided by 33,920 equal, okay, equal to, then multiply by 0.65. Multiply by
1.39.
That's why it's 1.39.
0.65. Final answer is what?
1.39.
Oh, okay, 1.39. Thank you. So here is 1.39. So that is the vital equity of a gear company. All right. So that's that. I will then move on from here. Let me push this one down. Let me copy this. Okay. Okay, board. Now that we have calculated step 3, we then move to step 4. Step 4 says we should calculate cost of equity using capital asset pricing model. Step 4. So how do you calculate capping? Let's copy the formula. Capping is risk-free rate of return plus beta multiplied by market risk premium. Let me just copy this too. No, let me do it that way. What's wrong with you? Let's finish it. Be careful with this mouse. Okay. So KE, cost of equity, is calculated as risk-free rate of return plus the beta value of the main company. Definitely don't write on my screen. Stop it. So I will then go to the question, what is the risk-free rate of return? Let's go and identify the risk-free rate of return. According to the question, we are told that corporate debt may be assumed to be almost risk-free and is available to Kilimanjaro at 0.5% above the threshold bill rates, which is currently 9% per year. All right, remember, the risk-free rate of return is the rate of return associated with government securities. All right, threshold bill is a government securities, and the rate of return on this threshold bill is 9%. Okay, so examiner is now telling you here that corporate debt, that is your KD, your cost of debt, is 0.5% above 9%. Okay, so that means our KD will be 9.5%. So let's move on from here. So here is 9% plus beta. We calculated beta in step 3 to be equal to 1.39. Then I need market return, RM. Let's go back to the question. What is market return? We are told in the question that the market return is estimated to be 16% per year. Okay, so market return is 16. Here will be 16, then minus risk-free rate of return of 9. What do you have? What's your final answer, please?
18.73.
18.73%. All right, so that's our cost of equity using capital asset pricing model. Then step 5, we calculate project-specific WACC. Project-specific WACC, denoted as KW. Let me copy formula for WACC. So like I mentioned to you, as far as project-specific cost of capital is concerned, it is assumed that the company is financed only with equity and debt. There is nothing like preference share here. Okay? So let me remove this blue stuff. All right then. So this is the final step. Step number 5. You can see it's not difficult if you know what you are doing. And it is the most common. It's the most common method of categories of work. Is the most common in ICAN. All right. If it doesn't come as a standalone question, it may be tested under capital budgeting or under business valuation. Okay. As we proceed, we'll be seeing more of this. So equity value of Kilimanjaro is 33,902. Is it 902? Let me confirm. Under regear. 920. Then equity plus debt. Let me just come here. Total value. Total value for Kilimanjaro equal to value of equity plus value of debt, which is equal to 33,920 plus 17,400. So what do you have here, please?
51,320.
51,320. $51,320. That's it. Instead of us to be doing it one by one, so you already have the total. So I will then come here. 51,320 plus cost of equity. All right. Cost of equity, we have calculated it in step. That's what we have in step 4, 18.73. Okay. Then value of the debts of Kilimanjaro is 17,400 divided by total value. Total value is 51,320. Then cost of debts. Okay, what is cost of debts? Examiner has told you in the question that corporate debt is assumed to be almost risk-free and is available at 0.95. Sorry, it's available at 0.5% over 9%. So that will be 0.5% plus 9%. That's 9.5. So I would then come here. Here will be 9.5%. Multiplied by 1 minus tax. This will 1 minus tax will give us 0.65. All right, so that's that. Give me from the left. Note. KD is equal to 0.5% plus 9%. That's what examiner told you. Therefore, KD is equal to 9.5%. We are doing this because of the information given in the question. Don't go and be looking for, don't think that at all time it will be 0.5% whatever the percentage plus your risk-free rate of return. You are going to treat it specific to each of the question. The dictate of the question will tell you how you are going to estimate it. So give it to me. What do you have from the left? Am I on my own?
2.09.
2.09. That should be on
From
the
the
right.
left. Oh, right, rather.
12.38.
That'll be 12.38.
Yes, 12.38.
12.38%. Add the two together.
14.47.
14.47.
So our project specific work is 14.47%. That's it. You can see it's not difficult. The only challenging thing there is your ability to be able to calculate the value of equity and debt for the proxy company and the main company. Once that is done, every other thing is just straightforward. Usually, project specific is it's always easy to calculate. All right. I'm very sure if I give you this question as an assignment, some of you will not get it correctly because of how to calculate your market value of equity. And that's why you just have to be able to think outside the box. Don't think that the question you have solved before, that's the way it will be, the scenario will be. No, examiner will always change something to make it look different. All right. In that case, your ability to be able to interpret the question and solve it correctly will determine your success on that particular question. So yes, Rabiat, talk to me. What's your question?
Good evening, sir.
Yeah, good evening.
I want to confirm, in the situation where the proxy company is not GED, do we just go ahead and reject using the formula for
In a situation where what?
The proxy company is on GED.
Is on GED. So you are going to ignore step 2. So you just use the beta you already identified in step 1 directly like that. So in this case, our own beta will then be 1.18. Sorry, yes, it just be 1.18. See if the proxy company is an on-gear company. So you just use 1.18 to re-gear. That's all. Instead of using 1.04. All right.
Okay, sir.
Okay, then. So let's move to requirement number 2. So in this requirement number 2, examiner is telling you that corporate debt is often assumed to be risk-free. Explain whether this is a realistic assumption and calculate how much and calculate how important this assumption is likely to be to Kilimanjaro's estimate of a discount rate in A above. For this purpose, assume that Kilimanjaro and the 4 freezer companies all have a debt beta of 0.3. So in this requirement number 2, there are 2 things you are going to do. The first one is that examiner is asking you to explain if truly corporate debt is risk-free. Then number 2, you have been given a beta of debt beta of 0.3. That means you need to re-estimate your work. All right. You need to re-estimate your work. Therefore, how do you solve this? Come back here. Okay, requirement number 2. There are 2 things you are going to do in the requirement number 2. The first one is explanation. All right. Explanation on corporate debts. Okay, you can just say corporate debts. Corporate debts. So examiner is asking you that, is it true that corporate debt is risk-free? Yes, let me ask the class if you have any idea on this. Yes. Is it true that corporate debt is risk-free? What it simply means is that when you invest through debt or whatever, you cannot lose your money. So because of time, let me just give you the assumption that corporate debt is risk-free. Let me go back to the question so that we follow through together. All right. So you are told that corporate debt is often assumed to be risk-free. Explain whether this is a realistic assumption. So that's the first requirement. All right. So you then say the assumption that corporate debt is risk-free is not a realistic assumption, or it's not realistic. The assumption that corporate debt is risk-free is not realistic, because if according to your own case, if you think that it is realistic, then you put it there. But in my own case, it is not. The assumption that corporate debt is risk-free is not realistic, because one, the first one is let's call it liquidation, under liquidation. All right. You know, when a company liquidates, let me just put it down so that we can finish this as quickly as possible. When a company liquidates, the assets will be realized. The asset will be realized, that is, to be disposed of. The asset will be realized, and the proceeds therefrom will be used to settle the liability, liabilities. Therefore, let me put it this way. Any outstanding debts not covered by the proceeds, will be forfeited. Therefore, or under this circumstance, corporate debts cannot be assumed to be risk-free. You know, like I explained in this, like I explained here, usually when a company liquidates, the assets of the company will be disposed of, will be sold, right? So, and then all the liability of the company will be used to settle the creditors. When you dispose of the assets of the company, any outstanding debts not cover, any outstanding liability or debts not covered by the proceeds from disposal, we cannot be recovered again. That means that will be lost. All right. So in that circumstance, we cannot say that corporate debt is risk-free, because there's what we call in business, there's what we call a separate entity. All right. The owners of the business is the liability of the owners of the business is limited to the amount contributed to the business. So you cannot say, because I'm owing you, for example, let's say I'm a director in Equity Professional Limited. Because Equity is a limited liability company, the liability of Equity Professional is limited to the capital that every directors or owners of Equity Professional has contributed there. So if the going concern, for example, that will never be the case of Equity Professional. If the going concern of Equity Professional has been threatened and then the operation has been brought to a stop, then in that case, what we need to do is to sell off all the assets of equity professional. We then use the money realized to settle any liability that equity professional is owing. So what we are now saying is that because of separate entity, whatever, the liability of the company, the liability of equity professional in this case is limited to the capital contributed by the owners. So you cannot use the personal assets of the owners to offset the outstanding liability. All right. So this is what we are saying here. All right. So let's move on. Let's add one more. Let me see. Somebody is sending charts. How did we get 9? Okay, somebody has already answered you. 9 is there in the question. All right. Then number 2. Number 2 is what we call default risk. That's what we call default risk. This represents, default risk represents the inability of a company, to pay the interest and the principal Okay, so when the customer or when a company defaults to pay interest and the company is also unable to pay the principal amount, of course, the worst case will be that the company will take the creditor. The creditor will take the company to court, and the court will settle the case. The worst case will be that, okay, I will tell the court that right now I don't have the capacity to pay, and then I intend to. How do you intend to pay? I'll be paying it I'll be paying it 1 naira every year, whatever the case may be. So because the company does not have the capacity to pay, that means the company has defaulted. So under that circumstance, it will be very difficult for the company to recover the entire debt or the entire loan. So under that situation, you cannot say that corporate debt is risk-free. All right. So what we are saying is that when somebody is owing you, you cannot lose your money. When an entity is owing an investor, right? It means that the investor cannot lose money on debts, which is not true. In fact, market condition can impair the ability of the company to settle the liability as a when due. So, yeah, that's that. So, I said this represents the inability of a company to pay the interest and the principal as and when due. Under this situation, corporate debts cannot be said to be risk-free. So these are some of the circumstances to pay interest and the principal. All right. So these are some of the circumstances. You can have more than this, but this is okay. Let me see. Somebody is sending charts. Okay. Definitely. So that answers number 2A. We then move to number 2B. Number 2B, you have been given debt beta of 0.3, which means that you need to recalculate your WACC. So in this case, I will just copy everything we have done before. So calculating project-specific cost of capital, where debt beta where debt beta of 0.3 is given. So now that you are given a debt beta, how are you supposed to calculate your project-specific WACC? This is B. Requirement number 2B. Okay. Let me bold this one. So all I need to do is to just copy all what we have done before. Yeah, just copy everything, which make life easy for me and for you too. I'll just remove one or two things there. I don't need step 1 again. All right, I don't need step 1. I already know step 1 to be 1.18. All right. So proxy beta remains 1.18. All right. Let me push this one down a little bit. Okay, so step 2, I don't need all this story. I can just rewrite it to say that since that beta is given, we have been given that beta. So since that beta of 0.3 is given, the formula below will be used to ungear. Therefore, I then need to calculate. Let me just copy this one. Get out. So this will then be, so like I told you, if debt beta is given, in that case, you are going to repeat the same formula you have in step 2. All right, that bit for nothing formula. So which is it? So beta equity, this will be debt beta, BD is debt beta, over debt value, multiplied by debt value, 1 minus tax. Okay, so that's that. This is the formula I gave to you last week for to ungear where debt beta is given. So we are given debt beta of 0.3. Let me write this one out. Copy this. Yeah. Okay. So in this case, my beta assets will then be equal to beta equity of a gear, and that is 1.18. Equity value of the proxy company. Oh, sorry. Yeah. So equity value of the proxy, all of this, all what you have here will still remain the same. The only thing that will change is this additional one here. So plus the debt beta, according to the question, is 0.3. Debt value of the proxy company is 40,100. 1 minus tax rate is 0.65. Then also, I just copy what you have here. To the other side. All right. So let's do, we have done the one of the left before. That's how we got this 1.04. So let's do the one on the right. So 1.04 plus. So what do you have from this one on the left, on the right? All
0.
of this.
0.4.
0. What?
0.04.
0.04. So when we had it, so 1.04, that will be 1.08. That's it. It's as simple as that. There is 1.08. So the next thing we then need to do is to regear, to incorporate the financial risk of Kilimanjaro. And I said to regear, just repeat the same formula you have in step 2, because that beta is given. Now also, before you put it down, before you put down your formula, you have to check from the question if you are given debt beta for the main company. In the question, because the examiner told you that you should assume that both the freezer company and also the Kilimanjaro have the same beta of 0.3. You know, we are told that for this purpose, assume that Kilimanjaro and 4 freezer companies all have debt beta of 0.3. That is why we are using the bid for nothing formula, all right, to regear, all right. Ordinarily, would have used the old one, the existing one, would have used this one. But because you are told that both the freezer company and also the Kilimanjaro, they have the same debt beta of 0.3. Therefore, you cannot use this one. So you have to use this formula you use in step 2. Okay? So in this case, we have already calculated beta assets to be 1.08. Let me remove this. So beta asset is 1.08. 1.08. We are looking for beta equity of a gear. This is what we are looking for. So that is unknown. Then the equity value of the main company of Kilimanjaro is 33,920. Okay. Then also 33,920 plus the debt value. Debt value is 17,400. Multiplied by 1 minus tax. That's 0.65. Okay. Then plus the debt beta of 0.3. Multiplied by debt value of 17,400. Remember what I told you. When you are regrading, you need the information of the main company. You don't use the information of the proxy company here. You see the way that I'm doing it. That's the way it is expected of you. 33,920. Debt value of Kilimanjaro is 17,400. Then 1 minus tax is 0.65. It's no more than that. So give me now from the left. It will then be equal to, here will be 1.08 equal to, yes, from the left, what do you have? 0.65 multiplied by 17.
9.
0. What?
749.
0.75.
0.75. 0.75 BEG. Let me copy this BEG. Then from the right, what do you have there?
$0.075.
0.075. Okay. So all we need to do now is to collect like terms, isn't it? This one will then be equal to 0.75 BEG Oh, sorry. I wanted to copy. Here is 0.75 BEG equal to 1.08. All right. Minus 0.075. So here will then be equal to BEG will be equal to
1.005.
1.005. Let me copy. Which one is smaller? This one is. Let me copy this. So this will be equal to 1.08 minus 0.075. You say it's 1.005, right?
Yes.
So divided by 0.75.
1.34.
0.75. You said 1.34, right?
Yes, sir. Yes, sir.
Okay. So that's that. That's a gear beta. We then calculate capping. You don't need to write out formula. You've already written formula before. So the only thing that will change is that this one will be 1.34. All right. The difference between 16 and 9, that should be 7, right? In any case, what's the final answer for your cost of equity using capping?
18.38.
18.38. That's it. Then we calculate project-specific work. Again, there's no need for you to be writing out formula. It's a waste of time. You've written it before. All right. The only thing that will change is your cost of equity, which is 18.38%. The other side, the right side will not change. It's the same thing. It will not change. So what do you have from the left? 12 point what?
12.43.
43%. So plus 2.09. Is it everything that is
14.552.
14.52%.
Approximately 15%.
So that's that. That's that. Of course, you can see there's a margin of error between the two work we computed. All right. The first one we computed was 14.47. This one is 14.52. All right. So there's a margin of error between the two cost of capital because of debt beta. Okay. What else? Finally, in the question, time is fast spent. In the number 3 requirements, examiner is asking you to discuss whether systematic risk is the only risk that Kilimanjaro shareholder should be concerned with. Let me just explain it. I don't need to write it down. What the examiner is asking you here is that you should explain if the company should be concerned only with systematic risk. Of course, the company should be concerned with all the total risk that affect the business, both systematic and then unsystematic risk. First thing first, you need to explain what is systematic risk, what is unsystematic risk. Then you can then advise that the company should should be concerned with the total risk that affect the business. All right. So that's that. So let me know if you have any question on this so that we can move to weighted average cost of capital of the combined activities. Any question on this?
Yes, sir. Okay, the last one. Good evening, sir. The last one you computed the regear. When we did for the debt side, we did 0.3 times 0.025. I got 0.075, but the solution I saw here is 0.75. If we can just look at the calculation again.
Which one?
The regear. When we calculated the regear, we did 17,400 times 0.65. All over 39.
It's 0.075.
Are you talking about this last one? Because what happened to maybe network has thrown that away. Anyway, should we call back? Yes, please talk to me quickly.
I want to ask a question. When the let's say they give us information about the new company, and the new company, they gave us like a capital structure about the new company, and the surrogate company, which is the proxy company, also has that's the same capital structure. Are we still expected to read there and do all these things?
What you are saying is that the main company and the proxy company have the same capital structure. Is that what you are saying?
No, like information about the new company this time around. Like
Your voice is
about
faint.
the new company.
I'm struggling to hear you.
Okay, so can you hear me?
Go
Can you hear
ahead.
me, sir?
Just increase your volume. Yes, go ahead.
Yes. Okay. I was saying that if they give us maybe like an information about the new company, like maybe just a capital structure or something like the new company, or if they give information about the new company and the capital structure of that new company will be the same as the proxy company.
It's the same as the proxy company.
Yes.
How is that going to be possible? Ordinary share capital of a proxy company cannot be the same ordinary share capital of the main company. There will always be difference now. We can't have the same capital.
New company, not the main company. I said the new company.
The new company.
Yes.
That is the proxy company.
Like if like we use like something similar, but I'm saying like maybe they give us information about this new company that we're actually trying to like get the appropriate beta for.
Maybe I'm not getting your question.
Yes.
As far as I'm concerned, what you are trying to say is that there is a new company, there is a main company, there is another new company, right?
Yes, like that's the new company that we're trying to get for now. Project, yes, like project specific work. The person like that project that we're trying to get for, if they give us information about its capital structure, is what I'm talking about.
So whether the capital structure of the main company will be the same thing as the existing company. Hello, peace.
No, well, don't worry, sir. No, sir. You're not getting my question. Maybe I'll ask later.
Okay. Possibly. We can you can send the chat. You can send it as a chat so that we know the right response to give you. Right? Okay.
Yeah. Good evening, sir.
Good evening. Go ahead quickly.
Yeah, please. For this same regear that we did, I mean this 0.75. I'm a bit confused. I don't know how we get that. Because my calculation,
you don't know how we got 0.
Yes, I'm getting a different figure. I'm not 0.75.
Finance, this is it now. Just you are going to start
Yes,
from the denominator.
exactly.
33.65 multiplied by 17,400 equal plus 33,920 equal. Then the 33,920 divided by whatever the answer you get will give you the 0.75. It's 0.74 something something. Then you round it to 2 decimal points.
Okay, thank you.
Okay. All right. So let's go to weighted average cost of capital of the combined activities. This is similar. Wakuka is similar to project-specific work, except that in Wakuka, we are going to carry out 7 steps. All right. Weighted average cost of capital of combined activity, of the combined activity. Okay. So like I said, I normally call it Wakuka. So when do you calculate Wakuka? And how do you calculate Wakuka? Remember, we said that cost of capital can be grouped into 1, traditional work, 2, project-specific work, then 3, Wakuka. So I've explained how to calculate traditional work, project-specific work. The last one is Wakuka. So when do you calculate Wakuka? This is computed. Let me just put it down. This is computed when a company is engaged in several different business activity. Almost at the same time. When this happens, a cost of capital or a uniform cost of capital that will be suitable to evaluate projects under each activity, under each business activity. We need to be estimated. All right. So that is when you calculate project specific. That is when you calculate Wakuka, weighted average cost of capital of the combined activity. So once a company is engaged in different business activities, so instead of using different cost of capital to appraise each of the activity, so a uniform cost of capital that will be appropriate or suitable to evaluate any of the projects we need to be estimated. And this is what is known as Wakuka. So what are the procedures, steps involved? So if you can see in a question that the company is into several activities, for example, a company is into real estate. This company is also into the communication business. But because the company has different business activities, so instead of using a particular cost of capital for communication, another cost of capital for real estate, Then you need to calculate a uniform cost of capital that will be consistent with the risk associated with any of the business. All right. So that's what is known as WACOCA, steps involved in calculating WACOCA. So God help us if we're able to finish this today. When next we are meeting, we are moving to a brand new topic. I'm tired of a cost of capital. This is our lecture day 6 under cost of capital. And that's our plan. Okay. So, like I said, anytime you want to calculate WACOCA, there are 7 steps. The 5 steps under the project specific plus additional 2 steps. So step 1 under this is to calculate or is to identify. All right, identify the beta of each activity. What is beta of communication business, for example? What is beta of real estate? So that's step 1. Then step 2, you ungear the beta if it is geared. The same way you normally ungear under project specific. All right, that's step 2. Let me label it. Here is step 1. Here is step 2. Then step 3, I don't need to write that formula. It's the same formula, but anyone that doesn't have formula before, I will give you the formula. So then step 3, what do? You calculate market value. Calculate market value of equity and debts of each activity. Of each activity. All right. That's step 3. The same way you normally calculate market value of equity and debts is the same way. It could be market value, it could be book value. Just calculate the value of equity and debts. All right. Then step 4, get out. I did not ask you. Step 4, you then calculate combined asset beta. All right. Calculate combined asset beta. Assets beta, or what we call weighted average. Weighted average asset beta. Okay, that's step 3, or step 4 rather. How do you calculate weighted average asset beta? Let me show you. Let me see if I can see formula that we can use. Okay, let's use this. So, to calculate weighted average asset beta, that is beta assets of the combined. Let me use beta symbol. Okay. Beta asset of the combined. All right, which is equal to the beta asset of the combined is computed as, let me use this side. I will need this. It's computed as beta assets of the combined, beta asset of the first activity Okay. Let me just copy it and dump. Vital asset of the first activity of activity 1 multiplied by, let me check if recording is on. Yeah. So this would then be, of course, to calculate the, like I said, to calculate the weighted average asset beta, denoted as BAC. Let me copy it, put it here. Weighted average asset beta or combined asset beta, whatever you want to call it. All right, so this is computed as vital asset of the first activity multiplied by market value of equity and debt of the first activity over market value of equity and debt of the first and second activity. We're assuming that we have only 2 different business activities. If you have more than 2, so it will be of first, second, and third activity. So in this case, you are going to have 3 different, let me just copy this. Okay. So this will then be for activity 2, total market value of equity and debts, the same way you normally calculate your market value. That's why you calculate market value in step 3. So you are just using that one as a proportion. Okay, so that's that. So this is the formula you are going to use to calculate combined asset beta or beta asset of the combined business. Okay, then step 5 is to then regear. Step 5, you regear to incorporate the financial risk of the main company. The same way you normally regear. This is step 5. Use the same formula. Then step 6, we calculate cost of equity. All right, calculate cost of equity. Using capping. Then finally, step 7. This is step 6. Step 7, you calculate Wakoka. That's all. It's no more than this. Step 7. All right. So anytime you want to calculate Wakoka, these are the procedures you are supposed to carry out. All right. So at this point, we can then solve questions. Let's solve illustration on this that relates to Wakoka. Wakoka is not common in ICAN. The most common of the 3 of them is project-specific work. All right, so let me have one of you to read this for us. Yes, who is helping us to read? Who is going to? Yes, Felicia, go ahead. Thank you.
Sir, I can't see clearly. I'm seeing you are required. I'm not seeing the upper part.
Okay. What about
Columbia?
now?
Yeah, I can. Columbia PLC provides training and financial services. The training service accounts for 2/3 of the value of the company. The company has a total debt to total market value ratio of 30%. The average beta and debt to total market value for financial service sector are 0.9 and 25%. The average beta and debt to total market value for training service sector are 1.5 and 12%. Other information includes the equity risk premium is 3.5% and the rate of return on short-dated government stock is 4.5%. Columbia PLC can borrow at 2.5% above the risk-free rate. Corporation tax is 40% on taxable profit. Assume that debt is risk-free. You are required estimate the cost of equity capital and weighted average cost of capital for Columbia PLC.
Thank you. That is the question. So you want exactly examiner is asking you to calculate cost of equity and then WACC of Columbia PLC. The most important thing you need to do is to go back, identify from the question, what kind of WACC do you want to calculate? Is it traditional WACC? Is it project-specific WACC? Is it WACOCA? So the information given in the question will tell you the direction that you should follow. So when you look at this question, in the first paragraph, you are told that Columbia PLC provided training and financial services. These are two different business activities. The activities in training is different from activities in financial services. So if that is the case, an examiner is asking you that you should calculate WACC. You need nobody to tell you that you are going to calculate project-specific WACC. Also, when you look at the question, examiner told you that training service account for 2/3 of the value of the business, which means that the financial service will account for 1/3 of the market value of the business. All right. So you are given information specifically for each of the business activity, the beta value, all right, and the debt equity proportion of training as well as the financial services. So when you have this kind of information and you want to calculate WACC, it has to be WACOCA. So I would then call me a solution. The name of the company is Columbia PLC, right? An examiner is asking you to calculate cost of equity and WACC. Don't need to waste your time and be calculating any cost of equity. Simply means you should calculate capping, right? So to get capping, you need to first of all identify the beta of each of the activity. Then step 2, you ungear the beta if it is geared. Step 3, you calculate market value of equity and debt of each of the activity. Step 4, you calculate weighted average asset beta. Then step 5, you regear to incorporate financial risk of the company. Then step 6, you calculate cost of equity. Step 7, you calculate WACOCA. That's all you need to do. It's not more than that. Therefore, I would then say beta. There's no need to say identify beta of each activity. Just say beta of each, or just say beta of the first one. What's the first activity? Training is the first one. So beta of training. Let's training equal to T, and then financial and financial. Let's financial equal to F. All right. We then go and identify the for training service. Let's go and identify the training. The beta of training. According to the question, we are told that the average beta and debt to total market value simply means debt equity proportion. So the beta of training is 1.5. Then financial service, beta of financial service is 0.9.
Right.
So here is 1.5. Financial service is denoted as F equal to 0.9. All right. So with this, we have identified the beta of each of the activity. So like I said, this is step 1. Let me board it. If I like, I can put this one. Get out. Okay. So step 2. Step 2 says you should ungear the beta. You will only ungear the beta and financial services are geared. So I will then go to the question. I want to know if there is debt in each of the activities. All right. From step 1 to step 5, you need information about each of the activities. So from step 6 to step 7, you need information about the company. Therefore, I want to know whether each of these, whether training and financial services, the beta of training and financial services are geared. They will be geared if each of the activity has debt. Okay, so of course they have debt. That's what the examiner told you, that debt to total market value for training services is 12%. All right, so debt equity proportion of training services is 12%. Then debt equity proportion of financial services is 25%. So it means that this beta of 1.5 and 0.9 is geared. If it is geared, then we need to ungear it. So I would then say ungear. So how do I ungear? I will go to the question to check if I'm given debt beta or debt beta is assumed to be risk-free. All right. So examiner has told you in the last note, examiner told you that assume that debt is risk-free. All right. So assume that debt is risk-free. So if that is the case, let me just copy the formula we have used before. All right. So let me copy this. Not this one. Yeah, this. I will also regret too. So let me just copy this once and for all. I will also need work. I will need this guy here. I will need work. Okay. Let me copy. Almost there. Okay. So to ungear, this is step number 2. All right. So to ungear, we calculate asset beta, which is, of course, you know the formula for calculating asset beta already. All right. So according to the question, the beta of training services. Let me start with training. BAT, that is beta asset of training. All right. So the beta of training services is 1.5. Okay. Then multiply by the equity value of training services. What is the value of training services? So according to the question, examiner told you that the training service sector has debt to total market value of 12%. All right. So if debt is 12%, it means that equity will be 88%. So this guy here will be 88 divided by 88 plus debt. Debt is 12%. She's 12. Then tax rates. According to the question, you are told that corporation tax is 40% on taxable profits. So if tax is 40%, that means we are supposed to account for 60%, 0.60. All right. So, oh, sorry. I used the wrong, that one is meant for formula. Okay. I'm supposed to use this one. 88 divided by 88 divided by 88.
Question.
This question is there now. Check your learning material is there.
I said I have a question.
You have, let's raise your hand now. You can't just stop me. You should have raised your hand. Then you ask your question. You know the rule already. So go ahead. What's your question?
Sir, please, why are we not using the beta of equity formula?
Beta of equity.
Why are we using this formula? Why not that beta of equity is equal to beta of assets 1 plus 1 minus t, then debt over equity?
Why are we using this formula to ungear? Is that what you are saying?
Yes, sir.
We are ungearing now. Is it not the formula to ungear? Yes, now, Felicia. This is the formula to ungear. And we are told in the question that debt beta is risk-free. So the other part will not be there. So this is the formula you are supposed to use to ungear. Look at it here. We've done it before. So to ungear, we use, in this one, we are told that debt beta is risk-free. This is the formula to ungear. That's what we used before. Okay? So you only use the other one, that big for nothing one. If you are given debt beta, that is when you use this double formula. So is it clear, Felicia?
Yes, sir, it's clear. Thank you, sir.
You're welcome. So what do you have here? What is your beta asset of training? 1.39. Thank you. Then we do the same thing for beta
Sorry,
of.
sir.
You guys will not follow simple instruction. I told you not to be disrupting me. Just raise your hand. I will allow you to talk. Go ahead with your question. Go ahead with your question.
Thank you. The task where I think is supposed to be 0.6 and not 6.5. I think they say 40%.
Yeah, you are correct. I think I was using the old one that I picked. I thought I've changed it. Thank you, Jerry. Yeah, 0.6. Tax rate is 40% on taxable profits. So thank you. Yeah. So that means the final answer is not correct. So let's change that.
So it's correct.
Oh, okay. You are factoring 60% already. That's
Yes,
fine.
sir.
So for financial service, beta asset of financial, that's BAF. The beta of BAF, sorry, the beta of financial service is 0.9. And then according to the question, the debt equity proportion of financial service is 25%. It means that debt is 25%, equity is 75%. So here will be 75 over 75 plus 25 into 1 minus tax. What's your final answer?
0.75.
0.75. Thank you. Now that we have the beta of training as well as the beta of financial service, we can then go ahead to calculate market value. Step 3 says we calculate market value of equity and debts of each of the activity. Okay, I will then say calculating market value of equity and debt of training and financial. Okay, let me change this one to black. All right, that gap is too wide. Let me adjust it. Okay. So in this case, according to the question, the examiner told you that training service account for 2/3. All right, 2/3 of the company's total market value. So it means that financial service will account for 1/3. So no need for you to go and be calculating market value again. In fact, you don't even have information to calculate the market value. All right. So this is step number 4 or 3. 3. All right. So examiner asks you, you are told in the question that training service account for 2/3 of the total market value of the company. So it means that the balance of 1/3 will be for financial service. Okay, so that's the market value. Then step 4 says we should calculate weighted average asset beta. I will then say weighted average assets beta or combined asset beta. Let me copy from the other side. We can also call it beta asset of the combined. Beta asset of the combined. So I will then come here. Get out. Oh, what's wrong with you? So the beta asset of the combined will be calculated. I think, let me just bring out if I've done it before in my explanation. Let me just bring out this one. Don't need to be wasting my time. So beta asset of, in this case, is no more the first activity. So you know the activity is training, all right, multiplied by total market value of training, and then total market value of training divided by total market value of training and financial service. Okay. Then on the other side, this will be beta assets of financial, total market value of financial over total market value of training and financial service, F, T and F. All right. Okay. Now that we have the formula, let me recopy and paste. Let me put this one. That's step number 4. So the beta asset of training service, we calculated 1.39. That's 1.39 multiplied by market value of training. Examiner told us that market value of training is 2/3. So that's 2/3. 2 divided by 3. Then the beta of financial service is 0.75. We calculated in step 2. 0.75 multiplied by market value of financial service is 2/3. The essence of calculating market value in step 2, in step 3, is to use it for the weighting. So we are using it as a proportion. So 1/3 is for training. Sorry, it's for financial service. So give me from the left, what is 2/3 multiplied by 1.39? What do you have there?
1.9.
0.93. The first one.
The first one is 0.93. Thank
93.
you. coming. Here is 0.93. And the second one is what?
0.25.
0.25. So when you add the two together, what do you have?
1.18.
Okay, 1.18. Equal to 1.18. All right, so that's the weighted average. Instead of us to be using 0.93 and then 0.25, you need only one beta, and that's why we calculated this 1.18. That's the combined asset beta. Okay. Then step 5 now. Step 5 is to regear. The formula to regear will depend on whether debt beta is given or debt beta is risk-free. Since we are told in the question that debt beta is risk-free, therefore, this is the formula we are going to use to regear. So to do this, I will then go to the question, what is my beta I've calculated in step 4? Beta is 1.18. Then 1 plus 1 minus tax. Tax rate is 40%, so we have to account for 60%. The debt equity proportion, like I mentioned, from step 5 to step 7, you need information about the company. Okay? You need information about the company. Therefore, I will go back to the question to go and check the debt equity proportion of the company. So in the first paragraph, you are told that the company has a total debt to total market value ratio of 30%. So the debt equity proportion of this company is 30%. So here is 30, 0.3 multiplied by 0.3. Or you can just say debt is 30, equity is 70. All right. Let me close this. So 30 divided by 70 equal multiply by 0.6 equal plus 1 equal multiply by 1.18. What do you have?
1.48.
1.48.
1.48. Thank you. 1.48. Then step 6, we then calculate cost of equity using capping. Examiner says you should calculate cost of equity. Using capping. Okay. KE. All right. So to calculate capping, you already know the formula. You write it out. So according to the question, what is risk-free rate? According to the question, you are told that the company has the rate of return on short-dated government stock is 4.5%. Risk-free rate of return is 4.5%. Then the beta value here is 4.5. We have calculated beta to be 1.48. Then market return, which is RM, according to the question, we are given equity risk premium of 3.5%. Difference between market return and risk-free rate of return is risk premium. Okay, so we have a risk premium of 1.48. What's that again? Let me check.
3.5.
3.5. Risk premium 3.5. So there's no market return. So here is 3.5. Difference between market return and the risk-free rate of return. Final answer 1.48.
9.68.
Okay, thank you. 9.68%. So that is that. That's step number 6. Finally, step 7, you then calculate WACC, which is which is a WACOCA. So it's no more than that. These are the procedures for calculating WACOCA. So calculating WACOCA. Don't go and be writing WACOCA on the day of your exam. WACOCA is my own, I'm the one that carved it as WACOCA. So if I thought you are going to write WACOCA, you write it out in full first. All right. So to calculate WACOCA, of course, you know the formula already. It's the same thing. So the first one, equity value. The equity value is 70% because you are told that the debt equity proportion, the debt to total market value of Colombia is 30%. So debt is 30%. It means that equity is 70%. There is no need for you to say 70 over 100. Okay, no need to say 70 over 100. Just say 0.7. Then you move on from there. But for the purpose of this class, because if I put 0.7, somebody will still ask me, what about the total E plus D? So let me just put it there as 100. Multiply by 9.68%. Okay, the debt value is 30% divided by total value of 100, 30 plus 70. Then cost of debts. Let's go back to the question. What's our KD? According to the question, you are told that Colombia can borrow at 2.5% above the risk-free rate of return. The risk-free rate of return is 4.5%. 2.5% above 4.5% will give us 7. Okay, so this guy is 7%. That's KD. 1 minus tax will give us 60%. Give me from the left. What do you have there?
6.78.
6.776.
6.78 or 76. Okay. Then on the right, what do you have there? 0.3 multiplied by 7 multiplied by 0.6.
That'll be 1.26.
1.26 plus 6.78.
8%.
8 point what?
8.04.
0.04%. You are correct. That's it. The WACC of Colombia is approximately 8%. I can say the WACC of Colombia PLC is approximately 8%. So this is the WACC that the company is going to use approximately. This is the WACC that the company is going to use to appraise training and financial services projects. All right, that's it. It's not more than this. All right. Let me know. Some of you are sending chats. Let me check. Promise. Are you yawning or you are crying? Which one?
Yawning.
Well, we are done already. So let me know if you have any question for me. So like I mentioned, as we progress into the diets, we are still going to solve more cost of capital. under capital budgeting, as well as where there are 2 questions that will involve project specific under capital budgeting. I think I have about 2 as well under the business valuation. So as we proceed, we'll still solve more. All right. So let me know if you have any question for me so that I can release you. Yes, Glory, talk to me. Glory, go ahead. Yeah. Yes, go ahead.
So everything is looking as if I don't understand it. Or I would say, let me first of all go back to the video when it says, and if I still don't understand it, maybe in the next class I can ask my question.
No worries. You're always welcome. All right. Glory.
Okay, sir. Thank you.
All right then. Cheers. Yes, let me know if you have any question for me so that I can release you.
No question, sir. No question.
Toluwani says, sir, please pity us, make we sleep. Emiko, what about me? Who is saying no question? Toluwani, you are still the same person. So you just want me to go
I'm not this person, no, but sincerely, no question. Any question, we will rewatch the video and ask in the WhatsApp group.
You just want me to release you. Okay. Good night, everyone. I will see you next time by the grace of God. Bye-bye.
Good night,
Good
sir.
night, sir.
Yes, sir.
Bye.
Thank
All
you,
right.
sir.
Sweet dreams, sir. Good night.
Thank you. Thank you. Lazy students. It's not easy. You know, you've gone out since morning. I'll come back again and then attending classes. It isn't easy, man. Thank God for everything.